Hi, everybody. Welcome to another session of Covera Insights. We are joined today by Devang Shah. He's the co-head of fixed income at Axis Mutual Fund. He's been in the financial markets for a fairly long time, and he's been with other AMCs also before this. He's been a fund manager since 2008 when he was with ICICI Prudential AMC. In terms of qualifications, he's a gold medalist in financial management. He's a BCom from Mumbai University, and he's a qualified chartered accountant. Hi, Devang. It's great to have you for this conversation.
Thank you. Thank you.
So Devang, what we would be discussing today, we want to understand a little bit about fixed income products. What is your outlook on fixed income? Why do you think there is an opportunity to invest in fixed income products more now than before? And then try and delve a little bit into target maturity funds.
Rightly said, Neerav. I think a lot of things have changed in the last 12 months for fixed income specifically. And if you look across that, there's been a seesaw change in bond market yields. I think probably last year at the same point of time, we were all talking about a very, very slow and gradual pace of rate hikes. We're talking about where I think central bankers were talking inflation, which is transient. They were talking about growth, which is fragile. And in the last 12 months, I think things have massively changed. Today, the themes have changed towards hyperinflation. Themes are started talking about that we'll be entering into recession for many developed market world economies. So there's been a seesaw change from a perspective on interest rates also. Central banks panicked after the Russia-Ukraine war, and they were so worried about what will be the impact on inflation, core of oil, rising oil prices, rising commodity prices, and the supply chain significantly getting stretched, that they have taken a call that they would have to front load the rate hikes. What we have seen across developed markets as well as, and the same thing has happened in India also, we have seen massive chain of rate hikes. From Fed, I think if you look across at the US markets, Fed has actually hiked from discount. Now probably they've reached for half, and they're probably still continuing on rate hikes. They're talking about another 50 to 75 basis of rate hikes. It will be slow and gradual. Similarly, if you look across at the Indian central banker, they have moved from 335 to an operative rate of 6/4, and we've actually seen the operative rate moving massively. Repo rates have changed from 4 to 6/4. 6.25, but actually the operative rate has moved from 335 to 625. So it's been a 300 basis of hike. The entire year, we've seen a lot of volatility in bond markets, muted returns for fixed income investors. But I think incrementally from here, after a lot of rate hike already behind us, most of the fears on inflation outlook and near-term inflation outlook actually looks quite on the lower side. You look at the 3-6 months CPI prints, headline CPI prints, not only in India, I think probably globally, would start tapering off. So a lot being behind us incrementally from here on, I think outlook for fixed income is quite positive. We are advising clients today, if you look across at the bond yields, I think from 1-year asset to 10-year asset, everything is available at 7.5. The curve has got massively flat. Last year, at the same point of time, the curve was very, very steep. If you look across, the 1-year assets were at 4.25. The 10-year corporate bonds were at 740, 750 levels. The 1-year has sold off, 10-year has broadly remained the same because a lot of front loading of rate hikes that happened, or probably of the fiscal fears. We've seen the 10-year significantly at an elevated level at the beginning of the year only. The curve has massively got flat. And still, I think inflation fears do persist. We are out of the danger zone. Incrementally, we are not going to see 7 and 8% of headline CPI. But are we in a zone where probably we need to go too bullish on fixed income markets? I would say no. We need to still remain cautious. Yeah. Inflation will continue to remain in the near term also above the central banker's mandate. Yes, US CPI will fall from the 7-8% handle, probably move towards a 4%. Similarly, in case of India, I think Indian CPI will move from a 6.5-7% handle to closer to 5%, 5.5. But they are still above the RBI's mandate of 4% and significantly above the Fed's target of 2%. Right. So for the next 12 months, what we believe is that RBI or Fed will probably do a couple of rate hikes more, take the operative rate in India from 6/4 currently to 6.5. Fed would probably go to close to 5%. All that is already in prices. But post that, we would have a stable rate regime for almost 6 to 12 months. We believe that we will not see any rate cuts in this year.
Oh, okay. That's great. The way I think what you already answered is that you do see that we are probably peaking or at least very near the peak
Yes.
from a rate cycle perspective. Now, from an investor's perspective, and oftentimes investors are also borrowers because they would have some of the other loan, whether it's in the form of a home loan, and home loans are typically being the cheapest type of interest rate products as a borrower that you can avail of. When rates go up there, EMI impact is significant. Now, investors will be very familiar with this because the impact comes immediately, and it comes in some cases there could be as much as, like you already mentioned, with a 300 bips delta on the rate side. EMI typically would have gone up by almost 30% for a lot of folks. But this is on the grim side. On the bright side, does that mean that if there is surplus savings available, or if your asset allocation has been skewed towards a particular asset class, does it mean that currently fixed income presents an opportunity to participate? And in that sense, probably a tactical asset allocation call, maybe for a 6-12 month horizon at least.
So Nirav, I think what we are advising clients always, and what we put across is first of all, SEBI has done a beautiful job of gating products or probably classifying products as per the investment horizon. So if an investor has a 3-month investment view, I think we have a liquid fund or an ultra short-term fund. Similarly, if we have 6 to 12-month perspective, we need to give him a money market or a low duration fund. So SEBI has kept this duration limits on each of the categories and probably provided a fund for each investment horizon. If it's a 3-year investment horizon, you have a short-term fund. If you have investor as a 10-year investment horizon, is a long duration fund. So I think keeping the investment horizon is first of all a much more important criteria as far as concern is whenever your investor wants to invest in fixed income funds. An investor will have a very, very good experience if he's actually matching his investment horizon with the category of fund which he's investing into.
Right.
Secondly, I think traditionally we have seen in India, like you pick up any time frame, I think I'm talking about the last 20 years now, inflation in India significantly doesn't go below 5. And similarly, inflation in India doesn't stay for too long above 7. Why? The reason being is above 7, it's actually detrimental to growth. It doesn't lead to, and I think a lot of books, a lot of literature has been written on the same, that above 7%, it will start impacting growth. So central bankers then somewhere down the line start hiking rates. Similarly, if it is significantly below 5%, central bankers will start cutting rates. Right. If inflation is 5 to 7%, generally the rates in India would probably be between 6 to 8. We are very close to, when we look across it, and I'm talking about rates, when I'm talking about FD rates, I'm talking about not the repo rate, because for a common man, what is applicable is the FD rate or what he's investing into. Today, we are already there at 7.5. Like 1-year CDs, I'm thinking retail rates have also, FD rates have also inched up now. I think 2 weeks back, retail rates were, FD rates were all between 6.25. Now they have probably moved towards a 6.75 to 7% band. Right. What we believe so that when mutual fund products are offering you 7.5, even if you invest in a 1-year product, I think the time has come, the opportune time has come for investors to have by design some allocation to fixed income. An investor will not go wrong much when he's investing in fixed income products at an absolute entry yields of 7.5. So I think opportune time is there. Most of the rate hikes are behind us. The local macro currently significantly augurs well for fixed income investment opportunities. To take the inflation outlook, it is going to go down lower. I think probably growth also is a mixed bag. For 2023, probably will not have such a high growth story in India. Right. Relatively, somewhere down the line, we will start seeing some bit of pain of, as you rightly pointed out, of high interest rate cycle. Costs have still remained elevated. The demand has to fall a bit. So it will not be a recession, but we'll see some slowdown. All this augurs well for fixed income products. And as I told you, the thumb rule at 7.5, the downside for investors on fixed income products is very, very limited. So yes, an investor has to be invested at this point of time. Just keep in mind his investment horizon, guide him the right product, and that makes a lot of sense for investors. And definitely, you'll have a very, very good experience.
Right, right. So, I'll pick your brains a little bit on the rate that you mentioned, that one year yields are at around 7.5%. And we'll go back a little bit to the basics, because this sometimes can become complex for a investor to understand. When you compare, when you say looking at a particular time period, there is also the investor also has the option to invest in a fixed deposit. An investor would also have an option to invest in a, let's say, a bond of a NBFC of some kind, right? Versus the investor would have the option of investing in a mutual fund, right? In the case of a mutual fund, one, of course, is that the NAV will keep changing on a daily basis, while your requirement is your investment horizon is fixed. So you have a 1 year investment horizon for, let's say, an X amount. For a Y amount, you have a 5-year investment horizon. You would find an option for doing the same amount of investment in an FD or a bond product directly, the security, it's at a security level, versus investing in a mutual fund, right? So could you explain how these two work differently, and where why do you think what are some of the complexities? Basically, that's that's always the question that if we can answer for investors, that makes making that decision a lot more easier in terms of flexibility, liquidity, etc.
So Neerav rightly pointed out, I think investor needs to understand that, as you said, that an fixed deposit is available for all the tenures, and probably how does a fixed income product help him to not only achieve the same similar kind of goals and returns, but also somewhere down the line is more flexible. So I think the most important element what we need to first point out is that when you're investing in a fixed deposit, what you're doing is you're investing in one particular bank. When you're investing in a mutual fund fixed income product or a scheme, I think what we also need to understand, the underlying assets are significantly diversified. SEBI has again put us across restrictions to the tune of 10, 8, and 5%, depending on somewhere down the line the rating. So if the rating is AAA, you need to have a single issuer of 10%. If it is AA, you need to have 8%. If it is single A, you need to have 6%. So what also comes across is the portfolio is significantly diversified. You're not investing in a particular bank or a particular NBFC or a corporate, where you're taking 100% credit risk on a specific issuer. Secondly, the most important element is FDs have a lot of lock-ins, and they have a slab rate. Okay, so XYZ slab rate. Okay, and the rate significantly, if probably you want a liquidity for some emergency, for some kind of meeting expenses, you want to plan a travel. I think what happens is you will get the relevant slab rate and a penalty to premature FD. When it comes to mutual funds, it works on a different format. You have an easy entry exit. You just put redemption. Most of the schemes which we are AAA oriented schemes have zero exit load. Secondly, the payout of that happens on T+1. So and there is no kind of penalty. So exit load is equivalent to a penalty in a kind of an FD format. So I think liquidity, the ease of flexibility at all point of times, and somewhere down the line, this entire concept of diversifications makes a fixed income product a better choice as compared to an FD. The another point which we also need to put across is that the taxation part. I think it's a very, very tax efficient solution. I'm sure every investor understands when it comes to FD, you are subject to the marginal tax rate. When it comes to mutual funds, you also get the benefit of indexation. So the tax efficiency plus the flexibility of liquidity at all point of times and the entire concept of diversification, and on a return perspective, ballpark, you are probably getting exactly similar kind of returns. Right. Today, if I look across at, as I told you, most of the retail FDs, if you look across any PSU or private sector banks, they are around 7%. The 2-year FDs. If you look across, that's a general investment horizon for retail investor. A 2-year AAA product, a corporate bond, is available at 7.5. So somewhere down the line, the returns are quite similar. In fact, probably a tad better. If you look at NBFCs also, I think large NBFCs, they are offering FDs closer to 7 quarter, 7.5 levels.
Right.
So when it comes across the mutual fund, the returns are broadly similar with the ease of flexibility, with the ease of liquidity, and a lot of importance needs to be given to diversification and the tax efficiency. So that is how probably I'll put across for a common man the differentiation between FD and fixed income products.
No, very well put. I just want to add a little bit more color on the tax aspect of it. So, if there is a like-to-like option, suppose you invest in an FD and a mutual fund, and you get the same return effectively, landed return, hold to maturity return of 7.5% in both the investments. In the case of a mutual fund, you would pay tax on the you would pay long-term capital gains tax, and therefore the maximum rate at which you will be taxed is 20% maximum rate. But indexation, actually, it's less than 20% because you will get the benefit of indexation in that case, and you always has the option to choose the rate that is more beneficial to you. So technically, 10% or with indexation 20%. Whereas in the case of FDs, you would have to deposit interest on accrued, you would have to deposit tax on accrued interest, and the income, it will be not taxed as capital gains, but it will be taxed as at the marginal tax rate, or it will be taxed as your income, which would mean depending on which tax bracket you are, you could end up paying 30% tax, 33% tax on your investment in FD. So on a like-to-like basis, taxation, there's a very clear delta between which product is more tax efficient. Also, the other point that you made in terms of being able to withdraw without having a significant penalty, of course, depending on how the rate cycle is moving, the NAV may move against or in your favor, but aside from that, there is no penalty once you're outside the exit load window. There's another nuance to it, though, isn't there? Now, let's say I had invested in a fixed income product with a 2-year or let's say a 3-year horizon in mind, right? 6 months ago, and at an NAV of 100 rupees. What if I stick to my 3-year horizon and I don't look at the NAV, then I'll probably achieve a similar return or a slightly better return than an FD product that I would have started around the same time, probably, right? But what happens, how does the NAV move in such scenarios when rates are rising? What happens to the NAV of mutual funds, fixed income mutual fund products? What happens when rates are sort of moving down? And you can just probably shed some light on it in the context of different periods, different maturities, so that it's easier to understand.
So Nilav rightly pointed out, I think it is an important concept which people need to understand is that in FD you get the interest income, and it is on the quarterly basis or half yearly and annual. There are too many options at maturity, cumulative at maturity. When it comes to fixed income products, what happens is the entire thing is more through appreciation through net asset value. It is an appreciation or a depreciation in the value of the investments which you make. A large part you need to focus across on is that, as I pointed out, if you are matching the investment horizon, I think significantly if you are entering, for example, there's so many products like short-term fund or target maturity funds, banking, roll down strategies, okay, where broadly a short-term fund is, you cannot go beyond 3-year duration.
Right.
Example, if you see actually an investor is coming in 2000, just like we have had like now almost 200-300 basis of rate increases. At the beginning of the year, short-term funds would be having a YTM of closer to, I think probably 6 quarter, 6 half levels. Today, they are all at around 7.5. A year back, probably they would be close to 6 odd %. Though they have seen a 200 basis of rate increase, okay, or repo rate increase moving from 4% to 6 quarter. I think what we need to understand, if the investor has come with a 3-year horizon at the beginning of the year, probably at the end of 3 years, yes, the first year might see some bit of depreciation in value because not exactly below 100, but somewhere down the line, you will see some hit to the NAV. But over a period of 3 years, because the next 2 years, we are actually not going to get any interest rate hikes. He will get a 7% kind of accrual. For the first year, probably the return can be 4%. For the next 2 years, if it is 7, the addition of the 4 plus 7 plus 7 probably will give you 18 rupees over a period of 3 years on 100 rupee of investment, which is exactly equivalent to somewhat a 6% interest, which you will earn on an FD if you would have invested a year back. A year back, a 2-year FD would be 5.5 to 6%. Even though we see some bit of volatility in the interim period on a fixed income product, if you are matching the duration of the fund and your investment horizon at the exit, interim volatility is keeping aside, at the exit of your investment, you would not see any kind of significant impact to your returns. So it is very, very important. One, I will re-emphasize on the fact that investors needs to match their investment horizon and probably find the similar kind of product. The experience for the investor will always remain quite positive and good. And the return, which probably they will also get from the product, will be very much similar and competitive at all point of times to other products available like FD or other tax substitutes in the market.
Right. That's a very valid point, and I think we've sort of have written about this also to build a laddering kind of an approach, and where you identify that this is my emergency pool of money. So this will keep lying in, let's say, liquid funds or short-term, very short-term funds with maturity less than 1 year, and and appropriately give returns with less, the least risk from impact of rate volatility.
Right.
But as we go towards longer maturity, so you build a basket of, let's say, you have 100 rupee requirement after 1 year. You want to keep 50 rupees in your, as an emergency pool of money. You have 100 rupees requirement after 3 years. So for the product that you've selected with a 3-year maturity, where you match the product, there you shouldn't be bothered about market volatility in the interim.
Right.
Because while the NAV is, because you're matching the maturity, markets will likely, if you hold it to maturity, the rate changes do not impact, the NAV at the end of the period.
Yes.
Or is likely to, sort of reflect in the return that is coming in the subsequent years. The other aspect is obviously the indexation will be in your favor when the rate cycle is moving against you. Indexation will move in your favor. So, but just trying to simplify this kind of a, invest according to your investment horizon, keep a basket and, allocate accordingly 1 year, 2 year, 3 year products, and don't worry about interim rate movements, because that is something that seems scary, but it is, if you take an action, then you've booked that loss. But if you sit tight and if you just hold on till maturity, then that, or for that horizon, then that issue, that loss will automatically go away, and it will translate into, and you will get the target returns that you were expecting.
So just to add to your point, whatever interest rate volatility you get, okay, if there was, as I explained to you, if you get 100 basis of or 150 basis of rate increase in a year, you're probably lost for a 2-year duration product 3 rupees of carry for the year. But what also happens, which you need to keep in mind, that the carry of the product which you had invested was 6. Now it has moved to 7.5. So even though the 150 basis of increase is happening, it will lead to increased carry from next year and an increased YTM for the product, which will give you interest at the rate of 7.5. So the next 2 years, what you have lost 3 rupees for the first year will be made up in the next 2 years, and the cumulative return, if you stay for the investment horizon, what you have decided will be very much similar to what you had invested at the beginning. So it is very, very important to stay into the product, and you have made a very, very good point to stay invested in the product, not take your loss and redeem from the portfolio.
So great. So let's move on to, so this has been a very interesting discussion, right? From trying to get what your view on the markets on the fixed income side, and also in terms of understanding the nuance between a fixed income direct investment versus a fixed income mutual fund investment.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.